Welcome to The Explainer. Today, we are digging into a really fascinating puzzle from an investor's point of view, the research and advisory giant, Gartner.
And this right here is the big question. You have a company that is an absolute monster in its market, a name Wall Street has loved for years, and all of a sudden, it's trading at a valuation we haven't seen in 5 years. So, what in the world is going on?
Check this out. The change has been absolutely dramatic. For years, investors were more than happy to pay a huge premium for this company, somewhere between 30 and 50 times its earnings. They were paying for quality, they were paying for growth. But today, that multiple has been just chopped in half, down to around 16. The market is screaming that something is wrong, and we're here to figure out if that's true.
Okay, so to really get to the bottom of this valuation mystery, we first have to understand just how insanely powerful Gartner's business model is. This isn't just some average company. For a long time, people have thought of this business as being pretty close to perfect.
And it all starts with just pure, jaw-dropping scale. In the tech research world, Gartner isn't just the biggest, they are the giant. We're talking more than 10 times the revenue of their closest public competitor. Think about that. That kind of scale gives them this incredible advantage in everything they do: research, hiring talent, building technology.
And that scale is what powers their competitive moat, which is just brilliant. It's this self-reinforcing data flywheel. So they have about 14,000 big enterprise clients. They have over 500,000 conversations with them every single year about their biggest problems. All those conversations generate terabytes of unique, proprietary data that literally no one else has. And then they pump that data right back into their research, which makes their product even better, which, you guessed it, attracts even more clients. It's a beautiful, virtuous cycle that's almost impossible for a new competitor to break into.
And the proof is in the pudding. Just look at these numbers. Even in a tough economy recently, Gartner still grew its revenue by 6%. Its main competitor, Forrester, their revenue actually shrank by 10%. That tells you that when times get tough, companies run to the leader they trust the most. It's a classic flight to quality.
Now, this is where it gets really crazy. That market dominance leads to just incredible profitability. Their main business, the Insights division, has a gross margin of around 74%. That's the kind of margin you see from a high-flying software company, not a services business. It's just wild.
And when you combine those fat margins with a predictable subscription model, well, you get an absolute cash printing machine. In 2024 alone, Gartner cranked out over $1.3 billion in free cash flow. This is the financial engine that drives the whole company.
So you're probably thinking, okay, this business sounds indestructible. What on earth happened to spook the market and send the stock down? Well, the answer is a perfect storm. A whole bunch of bad things hit all at the same time.
It was really a trifecta of problems. First, the whole global economy got shaky, and companies everywhere started cutting back on spending. Second, they got hit with a very specific problem related to U.S. government budgets, which put a drag on growth. And then, looming over everything, is the big one: the existential question of whether generative AI could one day make Gartner obsolete.
And you can see the impact right here in the single most important number for this business, contract value growth. It's the best predictor of future revenue. After growing at a super healthy 12% in 2022, it slammed on the brakes, slowing all the way down to under 5%. If you're an investor, this is the chart that gives you heartburn. So, with a perfect storm raging and the stock price falling, what did Gartner's management do? Did they panic? Nope. They launched a counterattack on multiple fronts, hitting both the long-term fears and the short-term problems. First things first, they ran straight at the elephant in the room, the AI threat. The big fear is that one day you'll just be able to ask a public AI for business advice and get an answer that's good enough, making Gartner irrelevant. Their answer is a tool called AskGartner. Now, it's their own version of a generative AI, but, and this is the whole point, it's only trained on their decades of unique, proprietary data. So they're changing the conversation. It's not Gartner versus AI anymore. It's their trusted, expert AI versus the public, anything-goes AI of the open internet.
At the same time, they made a really smart move on the sales side. They knew every client was obsessed with cutting costs, so they retrained their teams to sell services that do exactly that, helping companies save money. They're meeting customers exactly where their biggest pain point is right now.
But talk is cheap. Maybe the loudest thing management has said didn't come from their mouths, but from their wallet. Over the past 4 years, they've spent over $4 billion buying back their own stock.
And get this, they've been stepping on the gas.
As the stock price got cheaper, they started buying back shares even faster, snapping up over $500 million worth in just one quarter. That's management putting their money where their mouth is, and it's a huge vote of confidence that they believe their own stock is a bargain.
All right, so let's put it all together. We've seen the amazing business, the perfect storm it's weathering, and how management is fighting back. So where does that leave us? What's the final verdict for an investor looking at Gartner today?
Really, the entire debate comes down to two competing stories. The bull case says this is just a temporary storm. The business moat is still strong, and all these buybacks are going to create a ton of value when growth picks back up. The bear case? It says this storm caused permanent damage, that growth is never coming back to what it was, AI is a real threat, and this stock isn't cheap, it's a trap.
So, for this to be a winning investment from here, there are a few things you really have to believe. You have to believe the economy gets back on its feet in the next year or two. You need to believe Gartner can keep finding new customers outside of the tech department. You have to buy into their AskGartner strategy as a real defense against AI. And you have to trust that management will keep smartly buying back its own stock.
So in the end, it all comes down to one massive question. Is this a rare opportunity to buy one of the best businesses in the world while it's on sale? Or is the market right to be scared, signaling that this company's best days are now in the rearview mirror? That right there is the billion-dollar question you have to answer.